Accounting. So lessee is the one who is using a machine, okay, on lease basis, and lessor is the one who is manufacturing the machine. Okay, so now here I'm going to do this some based on lessee accounting perspective. Okay, so the one who is going to use the machine, now he can do this accounting under IFRS or under US GAAP. Under IFRS, this can be done uh, for uh, for financing. Okay, as a financing lease, it can be reported. Okay, and it can be done as an operating lease also. Now both are same only. Okay, both are same. And for US GAAP also, financing, all these are same. Okay, only for US GAAP operating, this is little different. Okay, little different, that you will come to know when I will do the sum. Okay, so for US GAAP operating, I'm going to use this green color so that you get the differences easily. Okay, so I'm going to explain this with an example of a sum, and then at the end I will articulate it in words, which is even more important. Okay, so first I'll begin with the sum. So let's say there is a company, okay, and this is a lessee. So this lessee has taken some machine and agrees to pay 10,000 every year for 4 years. So 10,000 for 4 years, and the interest rate prevailing at that time is, interest rate is equal to, let's say, 5 percentage. Interest rate is 5 percentage. So if this is the case, now if it is done through IFRS, okay, so if it is done through IFRS, then it will be done through financing lease or operating lease. It's one and the same, right? And even for US GAAP, all these are one and the same. So how should it be done? Okay, so that's what we are going to see now. So first, because it has been given the shape of financing, so we have to figure out, like, we have to convert this as if it has been financed. Even though lessee company says that they are going to pay 10,000 every year for 4 years, let me convert this into the shape of financing. How will I convert it? Okay, let me use this time value of money function, NIY, present value, payment, future value. Now here uh, N is 4 years the company agrees to pay. Interest rate prevailing is 5 percentage. Payment is 10,000. So 10,000 in minus, because it will be paid out. And so what is so if this will be paid out, so you think like as if your loan has been taken, for which installment of 10,000 every year has to be paid. So if your loan has been taken, what is the present value of the loan? That's what we are going to see. Future value is not needed over here. So when I key in these details into the CalC, I'll get the present value as the present value is 35,460. So this 35,460 is the present value. So it will be structured as if like a loan has been taken for 35,460 and the company is agreeing to pay 10,000 every year. Okay, so that's how it will be structured. So let me draw a table accordingly. So here, this is for balance sheet. Okay, so in the balance sheet, it will be shown as right of use asset. Okay, and this is for liability. liability. Now liability will be shown as 35,460, and so the asset is also 35, right of use asset. Okay, why do we say right of use asset? Because actually the asset is not bought, right? Because actually the asset is just leased. It is just leased, saying that 10,000 the company is going to pay. So because it is not the actual property, plant and equipment, so that's why we have given a new terminology as right of use asset or ROU asset. So here this is the asset value, so asset and liability. Okay, now uh, let me just form this table. So this is for year 0, this is the case. Now for year 1, I'm supposed to you know pay interest because it has been structured as if it is a liability. Okay, so let's say this is my opening liability. Opening liability will be 35,460, and I'm supposed to pay interest. Okay, so that's how the structure will be. I'm supposed to pay interest. Now interest will be, I'm supposed to pay 5 percentage. So this 5 percentage comes to 11773. Okay, and the amount uh, that I am going to pay. Okay, so amount paid is going to be 10,000, because that's what the company agreed to pay, 10,000 each year. Okay, so now the company is paying 10,000, but however the interest is only 1773. So what is the remaining amount? Remaining amount should be principal repaid. So principal repaid. So principal repaid will be 10,000 minus this 1773, that comes to 8227. 8227. Okay, and so this I'll keep this as ending liability. So after paying this, what is the liability? So it will be, initially it was 35,460 minus, now 8227 has been paid, so 8227. So now the liability left out is 27,233. Okay, and assets perspective, how it should be treated is, we will, because this asset is for 4 years they are going to use this. So 35,460 divided by 4 comes to 8865. So this is the depreciation every year, or we will not use the word depreciation because it's not the actual tangible asset, as I said. Okay, it's only for accounting, so we will use the word amortization. So amortization of 8865. So when I do amortization of 8865, so 35,460 minus 8865, so that comes to 26,595. Okay, 26,595. Okay, now the next year, second year, this will become the opening balance, 27,233, and on which 5 percentage interest has to be paid, that comes to 1362, and then 1362 is the interest, but the company pays 10,000. So if the company is paying 10,000, the remaining amount should be principal repaid, so which should be 10,000 minus 1362, so that comes to 8638. Okay, and the ending liability, initially this was the liability 27,233 minus, now this has been repaid, so 8638. So that comes to 18,595. Okay, so from this asset, so assets perspective, this is the liability. Assets perspective, 26,595 was there. We will again reduce 8865 because every year 8865 has to be amortized. So that comes to 17730. Okay, then third year it goes for, so this will be the opening balance, opening liability 18595, on which I'm supposed to pay 5% interest. That comes to 930. But however, the company pays 10,000, so that means remaining is principal repaid. So 10,000 minus 930, so that comes to 9070. So from the previous liability 18595, 9070 has been paid, so that comes to 9525. And assets perspective, it's the same, 17730 minus every time 8865 we are supposed to amortize, so that comes to 8865. Then fourth year, this again will become the opening balance, so 9525, on which 5% interest has to be paid, so that comes to 475, and 10,000 is the uh, you know amount paid, so the remaining will be 10,000 minus 475, so it comes to 9525 paid as a principal amount. So the ending liability will be, initially it was 9525, now this 9525 also 9525 paid, so the ending balance is 0. Assets perspective also 8865 is the one balance, minus 8865 every year I am amortizing, that comes to 0. So finally, the liability also comes to 0 and the asset also comes to 0. Fine. Now this is how you are supposed to do accounting for all this. Okay, financing lease, US GAAP, IFRS, and operating IFRS, operating lease IFRS. Okay. Now what if it is for what if it is for US GAAP operating lease, this part? So this part you will do the same, liability part. So you will do the same liability part. So let me just write over here, for US GAAP operating US GAAP operating lease. Okay, so this amount will be the same. I'm just going to copy paste it. So this is ending liability, and this one is ROU asset. Okay, so now ending liability, it was 35,460. So I'm just going to copy it, 35,460. It will be the same one. Actually, it's the same one, because the change will be only in the asset. Okay, the change will be only in the asset. Now in the asset, see here also 35,460. I am going to write the same one. You will find the change now. Now the change is for this is for year 0. Okay, so if you want, you can write all this down, all this, it will be the same stuff, right? So finally, for year 0, okay, it will be the same one. For year 1, 27,233. Okay, so how I got it, all these are mentioned already here. So 27,233, I'm directly mentioning 27,233. Then for the second year it will be 18595, 18595, and third year 9525. Okay, 9525, and fourth year it comes to ending liability comes to 0. Okay, so this is how it is. So same thing, whatever I have written up I am writing down. But when it comes to asset, I'm not going to do amortization of 8865. Instead, what I will do is, whatever be the liability, the same number I will report as the right of use asset as well. So 27233, here it will be 18595, here it will be 9525, and here it will be 0. Okay, so this is what US GAAP operating lease. So this is how I'm supposed to do. See, for this US GAAP operating lease income statement perspective, I will show under income statement as lease expenses of 10,000, because practically that's what the company is paying, 10,000. So that whole 10,000 will be shown as the lease expenses. That means this much of cash is going out in lease expenses, okay, under income statement US GAAP operating. So because of this reason, cash flow from operations, okay, will be lower. Okay, will be lower. Why? Because you are paying more. Okay, you are paying more. Because you are paying more, cash flow from operations will be lower in US GAAP operating in comparison to the financing part, or IFRS financing, or rest of the thing. Okay, in comparison to all this rest of the stuff. Okay, so here CFO is lower, whereas in IFRS then CFO will be higher then. Okay, so now how I show the income statement for IFRS is, IFRS as in I'm speaking about all rest of the thing. Okay, about all this rest. Okay, all this. So IFRS perspective, under income statement, how I will show is, because it is because under income statement, how I will show is, I will show that for amortization, I'm supposed to show amortization, which is 8865. Every year I am doing amortization. Plus I am also supposed to show interest expenses. So because I'm showing amortization of 8865 and interest expenses, let's say here interest expense was 1773. So first year 1773. So total comes to 10,638. This is for first year. Okay, first year. This is first year. For second year, again I will show amortization, which is 8865. Okay, and the interest expenses for the second year is 1362. So 1362. Okay, so total comes to 10,227. And third year amortization is 8865, and interest expenses comes to third year, it is 930. So 930. So the total comes to 9795, and for the fourth year amortization is 8865 and interest expenses comes to 475. 475 is mentioned here, 475. So the total comes to 9340. Okay, whereas for this one, every year, this is first year, second year also same one, third year also lease expenses same one, fourth year also it will be the same. Okay, lease expenses 10,000, so it will be same for all the years. Okay, so because of this, there can be, why am I writing all these things? Because we can draw some conclusions. Okay, the conclusion could be like, you see, if I add up this 10,638, 10,227, 9795 and 9340, all this will come to 40,000. That 40,000 is just what is paid under income statement here, 4 times 1 2 3 4, 40,000. But however, you see, under IFRS, initially the income statement expense is higher. Okay, initially the income statement expense is higher, and then as the year passes on, you see now the income statement expense is lower. So at the initial stage, income statement expense is higher. Okay, that's the takeaway point under IFRS. And at the later stage, income statement expenses will be lower. Okay, whereas total comes to all same, 40,000 only. Fine. So yeah, and this here in income statement, this in income statement, they are showing amortization 8860 and interest expense 1773, and because it is structured as a financing one, this 8227, okay, this 8227, okay, 8227, yeah, this amount is the principal repaid, because these are principal repaid, 8227, 863, 89070, because these are principal repaid, 9525, these are principal repaid. So this will be shown separately as cash flow from financing. Okay, cash flow from financing, first year will be first year it will be 8227. Okay, 8227. This is the first year cash flow financing, and because we are paying, I'm giving it in minus sign. Okay, for second year again, second year it will be 8638. Okay, 8638, I got it here, 8638, and 9070, third year. So third year 9070. Okay, and for fourth year is 9525. 9525. So because I'm showing all this in CFF, under CFF, so my CFF will go down. So my CFF will be lower. Okay, will be lower. Okay, my CFF will be lower in IFRS. In IFRS, it is lower, and so in comparison to US GAAP. So in US GAAP, the CFF will be higher, and in IFRS, it will be lower. Okay. And yeah, fine. So let me just highlight some points based on these calculations, and that will help you to articulate all this sum properly. So some key points here is, okay, number one, uh, the lease liability is the same each year under both methods, both IFRS or US GAAP, any method. Okay, you follow operating or you follow financing, it is same. This one, all these are same. All these are same. Okay, all these will be same. So such kind of statements can be tested. Okay, then the right of use asset is not the same, except at initiation of the lease, except at initiation of the lease and at the end of the lease. Okay, so that means here, so I'm using red color to differentiate things. So initially it is same, and then at the end it is same, but in between it is not. Is not same. Is not same. It is not same. So that's what it says. Okay. So let me give the heading also. So it is the comparing finance lease accounting and operating lease accounting. So that's the heading. Okay. And then operating leases report higher right of use assets. Okay, so operating lease uses higher right of use assets means, you see here, uh, yeah, this is operating lease, right? So for operating, the asset, here 27,233, this is higher than 26,595. Okay, so comparatively, in the operating, the assets value is higher. So here 18,595 is greater than 17,730, and 9,525 is greater than 8,865. So this is what they mean when they say operating lease report higher right of use assets. Okay, then the next one, the Right of use asset matches the lease liability. Okay, matches the lease liability in each year for the operating lease. Okay, so for the operating lease, both will match. So both will match. That's what they mean. The right of use asset only matches the lease liability at the start and end of the lease's life for the financing lease. So let me just underline here, for the operating lease, this statement, and this statement is for the financing lease. Okay, then third one, finance lease methodology. Finance lease methodology reports both interest and amortization expenses in the income statement. Okay, so that means, this part, both are recorded in the income statement for finance lease. Okay, operating lease methodology operating lease methodology uh, reports here lease expense equal to the payment. So that is under operating lease. It is equal to the payment. That means this is the lease expense which is equal to the payment of 10,000. Okay, so that's what it means. Then fourth one, okay, in the early years of your lease's life, the income statement okay, in the early years of your lease's life, the income statement expense is greater in in total for a finance lease. Okay. So in the early years of your lease's life, the income statement expense is greater in total uh, for your finance lease, okay, compared to operating lease. So what this means is uh, the income statement expense is greater. That means this is what I said. The income statement expense is greater 10,635 here. Here 10,000 to 27. So earlier it is greater and later stage it is lower 9795 and then 9340. So that's what this line means. In the later year, in the later years, income statement expense uh, is less for your finance is less for your finance lease. Okay. However, see in total the same amount of expenses, the same amount of expense goes through the income statement, okay, under both methodologies. Okay, what it means is finally the total all this this 10,365, 10,227, 9,000, and then 9,340, all this will come to 40,000. So this amount will equal to this 40,000. Okay, so that's what that line means. Fine. Okay, so these are all the statements associated with the sum. And if I tell you the impact on financial statements like this, finance lease under IFRS and US GAAP, and operating lease under US GAAP. So it goes like this. So balance sheet assets, that means ROU asset. Okay, ROU asset comparatively for operating lease it is higher. How it is higher? Because here I showed see, here it is 27,233, which is higher than 26,595. Okay, so and here 18,595 is higher than 17,730. So that's why, so that's what it means. So here it is higher and in under finance it is lower. And balance sheet liability, balance sheet liability will be same. Next one, income statement, income statement earnings early years. So early years income statement earnings will be lower. Why it will be lower? And US GAAP it will be higher. Reason being, because you are showing under say here uh, income statement early years it will be lower, because in the income statement you are going to show more expenses and then slowly it comes down. So early years it is lower and later years it will be higher, because later years the expenses comes down. So early years it is lower, and income statement earnings later years it will be higher. Okay, and vice versa here. So income statement um, higher here, reason being, comparatively, when you are showing higher expenses, so when you are showing higher this expenses, the income will be lower. Okay, under finances the income is going to be lower. So under finances income is going to be lower. Okay, and at the later stage it will be higher. Okay, so comparatively, when it is higher here expenses, that means lower income, and comparatively here lower expenses, that means higher income for operating. So higher income for operating. Okay, similarly this one also, second one. Then EBIT, earning before interest and tax, will be higher. Okay, it will be higher. So why it will be higher is, earning before interest and taxes under finance, why comparatively it will be higher, because this is earning before interest and tax. So interest and tax means this interest will not be considered. When you don't consider the interest, you are just reporting 8865, suppose, because you are not going to count interest expense, right? Because earning before interest, so you are going to count only 8865, 8865. Okay, 8865, 8865. Now all these 8865 are lower than 10,000. So because all these are lower than 10,000, your earnings, okay, in IFRS will be higher. Okay, your earnings will be higher. So that's why earnings is higher. So earnings is higher always, and here earnings will be lower always. Okay, then interest expenses. Interest expenses, it will be higher in financing, because just now I told, here you are showing more expenses. Okay, more expenses you are showing, expenses, interest expenses you are showing. So this is higher, and here it is lower comparatively. Then cash flow from operations. So cash flow from operations, this will be higher in financing and lower in operating. So this we have already discussed. CFO, here I told you it will be lower in operating. Okay, reason being, you are every time you are showing operations 10,000, 10,000, 10,000. So higher cash outflow is happening. That's why cash flow from operations will be lower. You will have lower cash flow from operations. Okay, so this is for operating. So that's why you have, for operation it is lower. Okay, and for uh, and for and for financing it will be higher, because you are not going to show that in operations. Okay, so you would rather show uh, that in financing. Okay, right, this part, uh, this principal repayment you will show will come under cash flow from financing, because this will come under cash flow from financing. Okay, so cash flow from financing perspective. Okay, so under financing you are showing more, so that's why your cash flow from financing will be lower. Okay, see, cash flow from financing, basically cash flow as in, you should think about cash inflow. So the inflow will be lower because every time you are showing cash flow as 8227 and 8638, 9525, 9070. So when you show cash outflow, so overall your cash flow financing, that means inflow, will be lower, and here it will be higher. Okay, fine. So these are all some of the points that you should remember when it comes to Lessee accounting. Thank you so much for your time.